Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitton, and Managing Director of International Content, Emily Parker. Good morning, Emily and Lawrence.
Good morning.
Morning. And Emily, I've got some good news for Dogecoin in you, so I'll have a bit on that just later. Taking a look at Bitcoin right now, the CoinDesk Bitcoin price XBX index currently trading at $47,138. Bitcoin is sliding back almost 3% over the past 24 hours. And the CoinDesk Ether price ETX index is at $3,793. That is pulling back 4.7% over the past 24 hours. And the CoinDesk DFX, CoinDesk's DeFi index, is retreating almost 6% for the day, down 376 points. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as leader in crypto news, events, and data. All right, so looking at Doge, however, I see that Elon Musk is tweeting about Doge, saying that Tesla will make some merch buyable with Doge and see how it goes. He's saying that Doge as payments is better than Bitcoin. It's causing Doge to surge. Happy news for you, Emily. I know you're a fan. Oh, I can't hear you, Emily. All right, we'll try to get that figured out. In other news, NYDIG, an institutional crypto infrastructure firm, also announcing a funding round of $1 billion that will value the company at more than $7 billion. The capital will be used to further develop NYDIG's institutional-grade Bitcoin platform. Lawrence, we've got some bullish news, a lot of things being built, Doge, infrastructure, and crypto. What are your thoughts on the markets?
Right now, markets are saying, so what? If you look at the futures market, and this is something that we reported in the past 24 hours, is that we have backwardation right now in the futures market, which means that the near dated contracts are trading higher than the far dated contracts. That could represent possibly a cooling in institutional interest, for instance. So, yeah, there's all this investment happening in institutional crypto, in institutional trading of crypto. But for the time being, we're not quite seeing it there, and that's why we're struggling to get above 48 at the moment. It's kind of surprising, but that's where we are. The alts are also taking a hit as well today, save for Doge, but let's remember where Doge is trading now versus where it was before. It hasn't gone back to those previous all-time highs. So the hype is not necessarily there.
Mm-hmm. Well, the Elon effect is taking place for Doge. The rest of the crypto markets have yet to follow. All right.
Things went south for Elon.
We'll hope to get Emily back later on. Let's take a look at our spotlight guest.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
So the U.S. Senate Banking, Housing, and Urban Affairs Committee is hosting a hearing today focused on stablecoins. How do they work? How are they used? And what are their risks? That's happening at 10:15 a.m. Eastern Time today, and we'll have that live streamed on CoinDesk.com. Joining us now to discuss is Dr. Ryan Clements, Assistant Professor and Chair of Business Law and Regulation at the University of Calgary Law School. Good morning, Dr. Clements. Thanks for joining us. So this is a very sensitive subject for Congress insofar as stablecoins mimic the U.S. dollar. I wonder, what do you expect to hear out of these hearings?
Well, first off, thank you for having me, and good morning. I'm quite interested, and we'll be watching these hearings in this. I expect to see a number of discussion points around both the risks of stablecoins, the variety of forms moving towards hopefully a taxonomy of forms, building on the President's Working Group suggestions. There's particular vulnerabilities for distinct forms, and there's a number of risk considerations. And I think we have a chance now for some thoughtful regulatory frameworks to be put forward. I think for a while now, particularly in the DeFi space, we've seen what I think is kind of a false dichotomy, which is regulate or not regulate. I don't think you can have healthy markets in this area, and I don't think you can really maximize the potential inclusionary benefits of some of these technologies unless we have some trust in these systems. And in order to get that, we have to have good regulatory structures. But with any type of regulatory structure, we have to also balance potential innovation chills. And so I think it's going to be interesting to see how they look to make that balance.
What are some of the greatest risks posed by stablecoins?
Well, we have to be particular about stablecoin forms. The term stablecoin is being used in a variety of contexts for digital assets that are not the same. We have some stablecoins that are collateralized off-chain. So we have things like USDC, Tether, which holds some type of collateral outside of the blockchain or the DeFi ecosystem, the crypto ecosystem. So this could be fiat, it could be government treasuries, it could be commercial paper. Now you have other types of stablecoins like DAI that are collateralized on-chain, so they're using some different type of crypto asset. And then you have what I'd say a third category, which is algorithmic stablecoins like Terra, Luna, which act kind of as its own central bank, modifying supply, but also building in embedded economic incentives for people to use the ecosystem upon which the stablecoin is built to ensure a stable value. So one of the things, I guess you could say, a unifying risk across all of these is run risk. So what actually happens if everyone redeems their stablecoins at the exact same time? Is there sufficient reserves to be able to redeem these on par? Is there some type of fractional reserve banking analog? Is there a potential for cascades and fire sales when collateral has to be sold? Or in the case of these algorithmic stablecoins, does the potential for redemption cause the ecosystem to be stressed in a way that it fails? That's just one risk per se. There's a number of other risks, from consumer redress, legal risk, IT risk, cybersecurity. There's a whole host of these risks, and I think we'll see these talked about today. But a fundamental risk in these is we have something which seems to be substitutable for money. We've seen this before, 2008, reserve primary, money market mutual funds. We've seen the substitution of money and what can happen when that money isn't redeemable at par. We have an analog to this, and so there's questions around how do we maintain stability of this? How do we ensure that this is an actual stable payment mechanism?
So, Dr. Clements, I was going to ask you about how you think the stablecoins would ultimately be regulated by the U.S. versus how you think they should be regulated. But before getting to that, I do want to ask you about this issue about a run risk, because with asset-backed stablecoins such as Tether, if the issuer is able to withhold for whatever reason or however they're able to do it, they're able to withhold a run on the bank on their reserves by making it, let's say, a difficult process to actually redeem anyway. Would it even be a threat? I mean, if people know that it's much easier to, let's say, buy Bitcoin and sell it for fiat using your asset-backed stablecoin, or they know that they could even trade it on the open market anyway, one for one, what incentive or what reason would they have to actually go to Tether or go to USDC or go to one of these other issuers and say, hey, here are my tokens, I'd like dollars back, if they can just do it much faster using the means that are already there? I mean, is that even really a threat?
It's a threat potentially. So again, we have to be precise on, I guess, the scope of the crypto ecosystem right now. And when we're talking about financial system stability risk and systemic risk, the risk of interconnections with the real economy, the risk of fire sales and cascades that can move outside of just the crypto ecosystem, it's hard to argue that we're anywhere near what 2008 was. It's hard to argue that we have a scenario where if we can't redeem these, we can just trade them into another crypto asset and it stays within the crypto ecosystem, there might possibly be cascade potentials that could move out of the crypto ecosystem. But where it becomes very, very concerning is when all of the factors are interconnected, all the way from Main Street, consumer behavior, businesses funding their employees, all the way up. If we have a scenario where flights to safety around what we think is money, to be able to turn that into something else that can affect the greater economy, I think that's where the larger financial system stability risks are. Right now, we have a scenario where what is thought of what DeFi and crypto could be in terms of its use value, its financial inclusionary potential, doesn't necessarily align with what it actually is right now. What stablecoins are right now are really just mechanisms to move in and out of DeFi or CeFi to create leverage on DeFi platforms to allow for trading positions. A lot of it is contained, however, within the crypto ecosystem, so it's not necessarily the same as what we had in the run-up to 2008. But it might be. Over time, it could grow to the point where as the larger utility of stablecoins, so having digital assets that are interoperable, that are faster payment mechanisms that allow for easier and lower fee global remittance and global payments, that then can start moving outside of the crypto ecosystem. And so even when you talk about putting in factors to ward against run risk, there's still some considerations about what those factors are and who chooses those factors and how those factors are defined, and are they consistent across stablecoin issuers, and does it depend on the types of reserves, and how do we deal with on-chain collateralized versus off-chain? How do we deal with algorithmic? So the variety of forms still, we still, and I think now's a good time to be looking at this in terms of moving towards at least some type of framework in these areas to define.
Dr. Clements, you do a great job of explaining the types of stablecoins out there, asset-backed, algorithmic, as well as off-chain. I'm wondering, out of all the stablecoins out there in existence right now, which ones give you the most cause for concern?
Well, I've published recently a piece on this in the Wake Forest Law Review about algorithmic stablecoins. I think algorithmic stablecoins are particularly vulnerable because of their design. So if we look at an algorithmic stablecoin, we're looking at something that isn't collateralized with anything except for its own issued investment token or some type of a claim. Now, what we have effectively is we have an issuer of a stablecoin that's acting in a way like a central bank. They're then embedding in the system of their stablecoins, and some, like Terra Luna, build into a larger DeFi ecosystem that connect into DeFi lending protocols and decentralized exchanges and payment mechanisms. They're basically a system that looks to control the supply of reserves and embed economic incentives into users being able to perform an arbitrage on these stablecoins to ensure their stability. Now, in a recent piece, I've argued that these are particularly vulnerable for three main reasons. And it's all based on financial market history. Number one, they require a perpetual level of interest, perpetual level of demand. It's not certain that will always be the case, even with these platform ecosystem plays. This is consistent with other scholars, and for example, the European Central Bank has said it's a bet on the expectation of its future market value. Other scholars have looked at these things and said, other types of stable coins, they peg their volatility to something else, but the algorithm ones, they interlink their volatility between the investment token and the stable coin. So the stable coin is only as stable as the investment token itself. And the investment token is based on market demand. And so there's an embedded vulnerability with that. Number two, they often rely on arbitrage in order to maintain the stable peg. And arbitrage has been historically fragile in financial crises. We can look to 1987, for example, and the portfolio insurance episode, where the assumptions of how arbitrageurs would act were different than how they actually acted. I see the reliance on arbitrage as an embedded form of vulnerability in these. And then finally, they rely on reliable price information and particularly oracles. And it's not certain that prices will be reliable, particularly in a crisis. And so I look at these algorithmic stablecoins and I go, well, what ultimately are going to be the use of these things? Is it going to be a scenario where they're used to move in between CeFi and DeFi in a crypto ecosystem or create leverage within the crypto ecosystem? Or could these actually ever have a off or outside of the crypto ecosystem financial utility? And in order to do that, there has to be some stability in those things to avoid a host of potential problems to financial stability. And I think because of their embedded instability, I just don't see them being used outside of the crypto ecosystem. So I think the purported benefits are vastly overstated.
It's really interesting that you mentioned algorithmic stablecoins. And I wonder, because they are building in their ecosystem billions, tens of billions of dollars in market cap, a lot of money on the line. So I wonder what would trigger a run on an algorithmic stablecoin.
So we have a history of what triggers the run. So interestingly, when we look to algorithmic stablecoins, we think in DeFi and large, we're using these words decentralization and disintermediation. It's not entirely obvious that it is decentralized. It's not entirely obvious that it's disintermediated, for that matter. The BIS put out a quarterly review a couple weeks ago where they said DeFi ecosystems have particular concentration risks, particularly in who holds the governance tokens, how consensus is done on proof of stake mechanisms. You have a scenario, and we can look to Iron Finance, and I know Terra Luna is different in terms of its ecosystem play, but the basic vulnerability is still there. You have concentration risk in holders of the balancer or investment token. Because of that concentration risk, there's the potential for individuals or groups acting in consortium to move markets in significant ways. Whenever they are able to make the investment token vulnerable, there's a potential for what's been described as a death cycle or a preemptive run. If the investment token becomes vulnerable in secondary DeFi markets, then it creates a motivation to run on the stablecoin, and then that can create a vicious cycle between the two that they can fail. We saw that with Iron Finance. The way that Terra is looking to avoid that scenario is building in an ecosystem play. So we have a use function across lending platforms and decentralized exchanges and payment mechanism. They're looking to integrate asset management, insurance in the future. But as I argue in my paper, it's still subject to three main vulnerabilities. It needs perpetual level of demand to be stable. It needs willing arbitrageurs to act at all times, and it needs reliable price information. And those things aren't historically consistent.
Dr. Clements, to push back a little bit, we talked to Do Kwon from Terra the other day. The argument you would make there is that the incentive structure at Terra is much different than what was going on at Iron. That they have better incentive structures. The other argument you could also make is that the size of it is much larger than Iron Finance. So there's less, so there's more capital, if you will, that would support it. What do you say to that idea?
I would agree that it is an improvement, definitely, to Iron Finance. It has better economic incentives. It provides for fee sharing. It provides for the potential for staking of Luna. But I don't think, and there's nothing, I want to be very clear that I'm not, saying that it's in either or proposition. I'm saying that that there are particular vulnerabilities with these types of stablecoins. Even with these additional economic incentives, they still require a perpetual level of demand. And so then we ask, well, what happens? What if there's a competitor to Terra Luna? What if it evolves over time where it's just not, maybe there's other protocols or other use cases that are better? If the demand falls off of Terra, the stablecoins come off as well. So there aren't. So then we look at these and we say, well, are they that stable? Could I use these to? Would I want to receive my employment check through these? Would I want to pay for groceries with these? Would I want to have my mortgage denominated in these? If I'm reliant on the perpetual stability of the Terra ecosystem for my money to be stable, it's not likely I'm going to use that. And so this gets into my larger argument, is that the purported benefits of some of these stable coins are curtailed and confined into the DeFi ecosystem. And it's not entirely obvious that the DeFi ecosystem is producing financial products that are being used by Main Street right now. It's lending protocols aren't being used to obtain small business loans and mortgages. They're being used to create leverage on DeFi for speculative trading with institutions. It's not entirely obvious that there's any financial inclusionary value outside of these ecosystems, which are institutional and highly volatile and highly leverage based. And so I look at these things and I say, well, if this is a better money for me, well, then I have to trust that. And in order for me to trust this as better money, if I know that there has to be a forever perpetual demand in this ecosystem for me to trust that money, I can't trust that money.
Dr. Clements, thank you for your commentary. Appreciate your insights on this subject matter. That was Dr. Ryan Clements at the University of Calgary Law School. Coming up, checking in on Asia and a crypto markets update with active investment manager, Titan.
Hello, I'm Jordan Muthra, Head of Studio Operations, and you are watching CoinDesk TV.
All right, time now for the daily forecast, an update on what's happening in the Asia crypto markets. Here's Angie Lau of Forecast News.
Welcome to the Daily Forecast, December 14th, 2021. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Concerns over inflation continue with the Fed meeting ahead, and that's seeing the crypto market's downward trend continue. We're going to take a look at the market action and a whole lot more coming up. Let's get you up to speed from Asia to the world. Let's kick off with some of the top stories coming out of Asia today. First up, Myanmar's National Unity Government, which lost power in February when the military declared a year-long state of emergency, has recognized Tether as an official currency. According to a Bloomberg report, Tether, the world's largest stablecoin by market cap, will be accepted for domestic use to speed up current trade, services, and payment systems. Meanwhile, Bored Ape Yacht Club, one of the world's most successful NFT collections, is joining hands with Hong Kong-based Animoca Brands to develop a play-to-earn game. Now, the game is expected to be released in the second quarter of 2022. Another hint that there is likely no stopping the metaverse juggernaut next year. You can find out more on those stories and a whole lot more at forecast.news. Now, over on to the markets right now, the downward trend continues with roughly 5% being lost across the board overnight into Tuesday morning here in Asia time. Forecast News' Lachlan Keller reports on what's behind this poor finish to the year.
After falling below the psychological $50,000 mark for the first time since October 2 weeks ago, Bitcoin lost 6% overnight Monday before stabilizing around the $47,000 mark Tuesday morning Asia time. One expert told Forecast News the price action is being dictated by short-term traders rather than long-term sentiment.
A lot of people expected Bitcoin to, or hoped that Bitcoin would hit 100K by year end. That looks really unlikely considering there's only maybe 15 days left till the end of the year. And so you've got a certain impatience, you've got some uncertainty, you do see prices going down. And so a lot of people are just going to sell out of that position and take the money that they have
Jonathan says he expects a range-bound market over the next few weeks with no significant movement until a real catalyst pushes things in one direction or the other. Meanwhile, Bitcoin's dominance has risen slightly over the last week as the pullback in altcoins has been larger, with Bitcoin seen as the safer asset to stay in. Other factors hitting markets of late include high-profile hacks of the exchange Ascendex and the crypto gaming ecosystem Vulcan Forged. For Forecast News, I'm Lachlan Keller.
Is the world of DeFi truly decentralized? Well, Swiss-based Bank of International Settlements, the banker to global central banks, BIS, certainly disagrees and piles into reservations about DeFi. Is it all that it's made out to be? Let's bring in David Lighton, co-founder of Lithium Finance, the man with a DeFi download, to dive into this topic and a whole lot more. Good to see you again, David.
Good to see you, Angie. Thank you so much for having me here.
All right, David, the BIS said last week that the world of DeFi is built on a decentralization illusion since the need for governance makes some degree of centralization inevitable. Is that right?
Protocols in DeFi, their own governance may not be as decentralized as they make it out to be. But the really, incredible thing about the DeFi movement is that we're enabling a world of peer-to-peer commerce. So I would urge the folks reading the BIS literature to consider, what they mean when they say decentralized. Are we talking about decentralizing whole industries and sectors and economies, or are we just talking about decentralizing governance of, individual companies and products?
The bank also said that DeFi can complement the traditional finance system, but has limited application in the real economy. What's your take?
It may be true that right now DeFi exists in a very crypto kind of world. I think in the longer term, you can't look at these two worlds as kind of compartmentalized. Hey, this is the normal sector and this is the DeFi sector, but there's going to be much more interplay in between the two. There will be a day in the future where we can trade real estate on chain, no problem. And I think that this is, again, something that the BIS really gets wrong.
Well, there you have it. Thanks for the DeFi download, David. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
Checking in on Bitcoin, the CoinDesk Bitcoin price XVX index is trading at $46,920. Bitcoin sliding down over 2% over the past 24 hours. Looking at the CoinDesk Ether price ETX index is at 3,770. ETH also falling about 5.3% for the day. The DFX CoinDesk DeFi index is at 377 points, sliding back about 6.5%. Joining us now to discuss the crypto markets is Clay Gardner, co-founder and co-CEO at Active Investment Manager Titan. Hello there, Clay. Thanks for joining us. So, what's your active management strategy in this sell-off? Is it buying Doge? Is it are you buying crypto? Is it time to buy?
Well, thank you, Christine, Lawrence, and Emily for having me. Maybe some context. So Titan Crypto is an actively managed portfolio of crypto assets that we believe are positioned for long-term returns with minimal correlation to U.S. equities and some attractive hedging qualities. And so our strategy is primarily to identify what we believe to be long-term winners. So winners over the next 3 to 5 plus years. And we're identifying those winners by what we believe to be fundamental research, looking at on-chain analytics. We're monitoring news flow. We're active in many of these social media communities, trying to understand the teams behind these projects, the real utility and use cases that are manifesting themselves. And so we're trying to balance that long-term perspective and philosophy with what is inevitably a lot of short-term noise. So we like to say we're macro aware, but we're not macro crypto investors. So we do pay attention and understand things like, I can tell you, so what we believe can be the winners over the next 3 to 5 years, we're really excited about layer 1 blockchains in particular. It's interesting. Coming into 2021, you still had a lot of institutional investors on the fence about crypto. And I think over the last several years, you started to see them go from, crypto is a career risk to it's almost a career risk not owning crypto. But the reason we're excited about layer 1 and layer 2 blockchains in particular is that we believe a lot of funds are sort of now leapfrogging Bitcoin, and they're jumping straight into layer 1 protocols. So Ethereum, Solana, Terra, Avalanche. And the reason is, if you think about these layer 1 blockchains, the reason the funds would skip the Bitcoin and go for the productive layer 1s is you've already seen those layer 1s as a percentage of total crypto market cap eclipse Bitcoin. And the reason is you're finally starting to see a lot of the R&D of the past several years manifest itself. And you started to see a peak of frustration around the cost of Ethereum as well in terms of gas fees. And so however you look at these layer 1 blockchains, and I mentioned a few of them, some of which our clients have positions in with Titan Crypto, whether it's number of users, whether it's total value locked, you're continuing to see these metrics grow exponentially. And you're also now starting to see somewhat of an on-ramp, the connective tissue between those layer 1 blockchains and many exchanges. So for example, a lot of exchanges starting to offer the ability to directly deposit and withdraw into layer 1s, bypassing Bitcoin or ETH entirely. So we're really constructive on layer 1 blockchains as well as a number of other assets. And I think it's really just about balancing that long-term perspective with what is a lot of short-term volatility, especially over the last few days.
Clay, as we're approaching the end of the year, do you have any price predictions for 2022 Bitcoin or Ether?
No price targets specifically for the next year. Emily, I think crossing the chasm is the way I would have described crypto over the last year or so, going from macro speculative asset to one that we believe is increasingly driven by fundamentals. And so I think what's going to change in particular, if anything, over the next year or so, is you're going to start to see a lot of crypto investors who previously saw crypto as a speculative asset, one based purely on technicals. So you're going to start to see a lot more investors value these assets, almost like traditional assets, maybe not with discounted cash flow models, but a lot of the relative valuation frameworks that I'm used to using as an equity investor. And I can talk about what some of those are. And so, no specific views to give on Bitcoin or ETH or any other coin specifically. We are constructive. We believe it'll be a great year for crypto. We believe talent is pouring into the space. You've seen VC funding in crypto over the last 11 months surpassed crypto funding by VCs over the past decade. And that those dollars are going to get deployed. And so I think overall crypto market cap should be higher and could be significantly higher over the next several years. Perhaps we want to talk about our position in Coinbase for our flagship clients. We believe that's another way to get exposure to that crypto market cap upside. But I think it's just going to be another really exciting year in terms of the pace of development and the amount of adoption that retail investors are going to be able to have in the space.
So, Clay, getting back to your discussion about leapfrogging into the other layer ones besides Bitcoin, if we're going to talk about relative valuation, won't in many ways Ethereum get a lot of the attention of those people who are, or most of the attention of those who are leapfrogging, if just because it's something that they kind of know a little bit better. It has the so-called network effect, if you will, that some of the other, even the Solanas of the world might not have to the extent that ETH does. Do you think that ETH might, in many ways, outperform some of these other smaller layer ones over the course of, let's say, the next 12 months while investors sort of get their feet wet and try to figure out what's happening? Or do you think that we might see some outperformance from some of these other layer ones?
I mean, that's a really great question, Lawrence, because ETH is still the largest decentralized operating system. In many ways, we think it's the most battle-tested blockchain in the world. And so that security layer will anchor a lot of the next iteration of the internet, what we're talking about with Web3. But in particular, when it comes to valuation, I think it's a really great point because, again, as an equity investor, you have cash flow. That's like the ultimate arbiter of like productive value and utility. You don't really have that for most crypto assets and even layer one blockchains. What's unique about ETH is, you do have gas fees, right? And so, one quick example could be, the last 30 days, ETH generating about $1.5 billion of gas fees. And so that's about $18 billion of annualized gas fees. And if you take the market cap of roughly $450 billion, divide that into the $18 billion of annualized gas fees, you get sort of a 25 times multiple. You can call that sort of an EV to revenue or a price to earnings multiple. That's roughly equivalent to what we're seeing in the high growth software as a service camp today. So, software as a service companies trading on the public equities exchanges, growing 30% plus are trading around that multiple. And obviously ETH is growing leaps and bounds faster than that. So that's one example of a valuation framework where I think if you're an institution and you've been participating in equities and macro, et cetera, that's a pretty ascertainable framework you can sort of get comfortable with. The more you get into other layer one blockchains that don't have quite as tangible a framework for sort of value and utility, you have to be a little bit more cute around relative valuation. So, for example, market cap to total value locked, or market cap to daily active users or daily active addresses. So it's not as tangible. You're sort of making, obviously, a leap of faith and a bet that the growth of those underlying user and transaction metrics will ultimately manifest itself in some sort of cash or fees-based revenue stream. But I do think that a lot of institutions, ETH could be the new Bitcoin in many ways, right? It's like it is the new on-ramp for funds that do leapfrog Bitcoin, jump straight to more productive layer ones. But I don't think it'll be the end of the development for layer one blockchain development and investment interest from institutions, even if they go straight to ETH
Clay.
in the coming months.
Thanks for that clear analysis. Appreciate your insights. That was Titan co-founder and co-CEO Clay Gardner. Coming up, folks in crypto aren't afraid to travel. We'll have a look at where they're coming from and where they're going. Plus, our CoinDesk Global Policy and Regulation Update with Managing Editor Nick Day.
Hi, I'm Christine Lee.
Zach Seward.
I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Doreen Wayne.
I'm Nicholas Day.
Hi, I'm Kevin Worth.
My name is Naomi Brockwell.
I'm Jordan Muthra.
Hi, I'm Galen Moore.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi.
You're watching.
And you are watching.
And you're watching CoinDesk TV.
Welcome back. Time to check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day. Good morning, Nick. So we have a highly anticipated hearing in Congress today on stablecoins. Give us the lowdown.
Good morning. Yes, we are just under 45 minutes or so away from this hearing. Not a lot to add from yesterday, really, but we have the opening statements for the witnesses, and pretty much as expected. It's there's a fair amount of skepticism from the parts of Alexis Goldstein and Professor Allen. Fair criticism in some cases, and comparisons about the fees and concerns about the user impact of trying to use stablecoins. And on the other hand, you have Dante Disparte talking about the benefits he thinks stablecoins could provide. And I imagine the questions are going to be fairly honed in on these different aspects of are there consumer risks, are there financial stability risks, or otherwise what is the actual real ability for stablecoins to enact certain goals such as financial inclusion.
So, Nick, I think it seems fair to say, given the last hearing that we just saw, that the questions will probably be pretty sophisticated, right? Like this is going to be a fairly substantial hearing. Do you think?
This hearing, hopefully, yes, I think so. I think there's going to be a little bit more, passion, I think, on the parts of some lawmakers. And, in particular, I honestly do expect quite a bit more skepticism about the promises made by the digital asset industry, as well as the actual, cryptocurrencies in question, just because this is, going to be a very focused hearing on stablecoins. And, we've even seen in promotional materials from the committee that there are questions about, whether or not stablecoins are even, for example, backed fully the way they claim to be.
So, Nick, quickly, a lot of these hearings, as we know, are just people kind of like talking, right? So, I mean, what might actually come out of this hearing? Anything specific?
It's hard to say. I think, given that this is coming close to the very end of the year and whatever work is done today will have to be picked up in 2022, I think this is really just going to be kind of a groundwork laying hearing. It's probably going to be, some amount of folks just talking, but also just kind of, early stage, trying to figure out what's going on and how can that be applied into a regulatory framework or policy framework to be introduced further down the line.
All right. Thanks, Nick. And folks, if you want to watch that hearing, it will be live streamed on CoinDesk.com, so keep watching after the show. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. All right, 'tis the season to be traveling. According to travel booking site Travala.com, hotels, flights, and other travel booking sales on their site jumped almost 700% in November compared to the same time last year. Over 80% was paid using crypto. Joining us now with more is Juan Otero, CEO of Travala. Hello there, Juan. Thanks for joining us. So I guess the COVID, what? Are crypto holders no longer quarantining or staycationing?
Yeah, we've seen a nice uptake in booking volumes across the board. Obviously, I think it's a reflection of what's happening, the intersection of two fast-growing industries, both crypto and travel. We processed over 10,000 room nights booked across over 100 different countries in November, which is significant growth again, month on month and year on year. But perhaps the most significant point is the actual amount of bookings that have been paid with crypto, which hit another record at 82% of the total 7 million plus paid in bookings during the month of November alone, paid in different cryptocurrencies. So great to see that people are starting to travel again, and obviously very happy to see that a lot of these users are choosing Travala.com as a destination to book travel.
Interesting. Juan, I wonder, where are people traveling to and where are they coming from?
Yeah, it's a very global approach. So we saw over 100 different countries being booked during the month of November. Obviously, you have destinations like main European cities, Paris, Rome, Berlin, and also the US as the main areas that people are traveling to and from. And some pretty, popular crypto destinations like Miami and Dubai as well at the moment is getting a lot of traction. But yeah, very globally distributed. And as travel starts to open up and, travel restrictions start to ease, we see a lot of different pockets of demand popping up in different regions, which is great to see. And obviously we're expecting a massive travel rebound heading into 2022 and beyond. Also because of the amount of pent-up demand due to COVID-19, yeah.
So I have to ask, what's going on with China? Why is China on that list? As we know, China has undergone a pretty severe crypto crackdown over the past year. And also, so if you just have any information about that, that's kind of interesting. And also, what is the scale that we're talking about here? When China is number 4, how many people are we actually talking about? What volume are we actually talking about?
It depends. So in November, for example, for hotel accommodations, so we have 3 main verticals: accommodation for hotels, flights, and activities. In China, we see a lot of local travel or internal travel, domestic travel as we call it. A lot of people in China will choose to pay with credit cards and traditional payment methods. We also allow Chinese users to pay with WeChat Pay, for example. Whereas we see a lot more crypto adoption in terms of payments in other regions like Europe and the US. But we're still seeing a few thousand, bookings every month coming from China, but not so much paid with crypto as other destinations. Yeah.
Yeah, the number one country you have where people are leaving from is Turkey. How much as a percentage or to what magnitude is that compared to the number 2 country, which I believe was the Netherlands? Is it a multiple of that number? And what's the magnitude? And also, are people just trying to lock in rates using crypto because they're worried about the value of the Turkish lira?
Yeah, it's a good question. We do have a lot of traffic coming from Turkey, but in terms of book destinations, the US remains our main destination, followed by a lot of the main European cities. A good answer to this is obviously the level of adoption of crypto that we see in Turkey. And we had managed to build a growing community of users that travel from Turkey to different destinations. It's been in the top of our visited, or the most visitors coming for the platform for quite a few months now. And we plan to continue to to grow the community in Turkey. But yeah, still the main destinations book remain the US and many European cities. Yeah.
So what kind of crypto are they using to pay for travel? I noticed Avalanche was at the top there. Why Avalanche?
No, that's AVA. So that's the native token of the Travala.com platform. That represents around 12% of the total booking volume. We do allow people to book with Doge as well, just like Tesla with the announcement today. We do actually offer 60 different cryptocurrency payment options on the platform, as well as traditional fiat payment options. But there's a number of benefits attached to using the native platform token, which is the AVA token, including loyalty, rewards, discounts, and so on. And that is, together with Bitcoin and stablecoins, one of the most popular payment options.
All right, Juan, thanks for joining us. Appreciate your insights. That was Travala CEO Juan Otero joining First Mover as part of Culture and Entertainment Week at CoinDesk. Food, travel, art, and music, NFTs, the metaverse, and more. It's all part of the series. Visit coindesk.com/culture-week as new articles and videos are added all week. Time now to check in with Crypto Twitter for our tweet of the day.
Can we just not have metaverse be like invented by Facebook?
All right, that's Keanu Reeves talking to The Verge about his thoughts on virtual reality, the metaverse, and more. He also said he hodls some crypto and he doesn't think much of NFTs. We love you, Neo. We have all taken the orange pill. That's it for First Mover. Thank you, Emily Parker and Lawrence Lewitton. I'm your host, Christine Lee. Maybe you'll see some Matrix resurrections, anyone? All right. I'll be back live at 3 p.m. for all about Bitcoin. Coming up at noon is the hash. Also, watch our live stream 10 a.m. for that stablecoin hearing in Congress. You're watching CoinDesk TV.